The people who run the biggest banks in America got together in a recorded meeting and said this to each other: "Don't let depositors find out how this actually works, because if they do, they'll move their money. And if enough people move their money, the whole thing falls apart." That is not a theory. It was recorded at a government meeting. Former heads of Goldman Sachs and JP Morgan said it on camera. So let me tell you what they didn't want you to know, and more importantly, what the people who did find out are actually doing about it. Because here's the part that should make you stop scrolling. Everyone's been asking the wrong question. Everyone's asking, is my bank okay? And the real question is, why are you still relying on a system that was designed to absorb losses from the bottom up, with you at the bottom? I'm going to show you 3 ways your savings are more vulnerable than you think. And then I'm going to show you what people who actually understand this system are already doing to get outside the blast radius. Not by panicking, by making 3 specific moves. Stay with me on this. Because the third move is the one nobody talks about, and it's the one that changes the whole equation. Your bank is legally required to keep $0 of your deposit on hand. Not a small amount. 0. That changed in March 2020 and was never changed back. Before that, banks had to hold at least a small percentage of your money in cash, just in case you came to get it. That rule got eliminated, and nobody brought it back. Think about what that actually means. You deposit your paycheck, the bank takes it, they invest it, lend it out, put it to work somewhere else, and they have no legal requirement to keep any of it sitting there waiting for you. When you go to the ATM and get cash out, you are not getting your money. You are getting money that happens to be available at that moment, because not everyone asked at the same time. And here's the thing most people get wrong. They think the FDIC makes all of this okay. They see that logo at the front of the bank and assume it means their money is fully protected no matter what. So let me give you the actual math. The FDIC is the government agency that promises to cover your deposits if your bank fails. Right now, their insurance fund holds $153.9 billion. That sounds like a lot. It's not, because the deposits they've promised to protect total over $10 trillion. That works out to about $1.42 for every $100 they've told you is covered. $1.42. That is your safety net, and that number took a serious hit just a few years ago. After 3 major banks collapsed in 2023, Silicon Valley Bank, Signature, First Republic, the FDIC had to go borrow tens of billions of dollars just to cover the damage. They had to borrow money to pay out the insurance they sold you. The fund that was supposed to protect you ran short and went to the government with its hand out. So the question isn't whether your bank is solid. The question is whether the fund behind it can handle a bad day. And based on the math, one bad day is about all it can handle. Here's something almost nobody knows. When you put money in a bank, you are not storing it safely like a car in a garage. Legally, you are lending it to the bank. You gave them your cash, they gave you a receipt, and in the eyes of the law, you are just one of many people the bank owes money to, and not the most important one. In 2008, when big banks started collapsing, the government stepped in and bailed them out using $700 billion of taxpayer money. People were furious. Congress said never again. They passed a law. You've heard it called Dodd-Frank, and said taxpayer bailouts are over. Here's what they replaced it with. Under that same law, if a major bank fails now, the bank rescues itself using money from its own depositors, meaning you. You skip the tax man, but your money is still what plugs the hole. They just changed the label. They call it a bail-in. You do not vote on whether it happens. Now here's what makes that even worse. That same law also says that when a bank is being shut down and the money is being divided up, the giant financial bets the bank placed with other banks and investment firms get paid out first, before you do. You are standing in a line you didn't know existed, behind trillions of dollars in bets you never agreed to. And before you say, "Sandy, that's a hypothetical. That could never actually happen to a real person," it already happened. In March 2013, in Cyprus, a country inside the European Union, with a central bank, with deposit insurance, with every promise you've been given, depositors woke up on a Saturday morning and found that nearly half of everything they had above the insured limit was gone, converted to worthless shares of a failing bank. Banks closed for 2 weeks. ATMs ran dry by Monday. The ability to move your own money out of the country was locked down for years. 12 years later, people are still filing claims trying to get their money back. That was not a poor country with a broken system. That was a modern European country with the same protections you have right now. So now go back to that meeting, the one on tape. Former heads of Goldman Sachs, Citigroup, JP Morgan, former Federal Reserve officials. And one of them said on camera in plain language, people need to understand they can get bailed in, but you don't want a bank run, so you keep it quiet. Count on people not looking. They were right. Most people never look. Most people are still depositing their paychecks, trusting the logo on the building, and assuming someone else read the fine print. If you're still watching, you are not most people. And what's coming next is the move that even most financial advisors have never made themselves. Because making it means admitting something uncomfortable about the system they work inside. 3 weeks ago, on March 19th of this year, the Federal Reserve, the FDIC, and a third federal agency held a vote. After the 2008 crash, regulators had told the biggest banks in America, you have to keep a bigger cash reserve as a safety buffer. The idea was simple. If your bets go bad and the bank starts to collapse, that buffer absorbs the damage before your depositors get hurt. That was the deal. 3 weeks ago, they voted to shrink the buffer. The new rules let the biggest banks keep less of that safety cushion than before. The Federal Reserve voted 6-1 in favor. The only person who voted against it was the one board member who had spent years pushing for tighter protections. He lost. The agencies themselves said in their own press release that the total safety buffer across the banking system would go down under these new rules. Here's what that means in plain terms. The thing that was supposed to stand between the bank's bad bets and your savings account just got smaller. They did not announce it on the evening news. They did not ask you. They voted, and now you have 90 days to say something about it before it gets locked in. There is a public comment period open right now. It closes June 18th. If you go to regulations.gov, you can submit a comment. They are legally required to read it. Whether they change anything is a different story. But if you want your objection on the record, the window is open. Now I know what some of you are thinking. The system has survived before. Maybe this is fine. Maybe. But here's what I keep coming back to. The people who designed this system are not betting their own money that it's fine. Warren Buffett spent the last year of his time running one of the most respected investment firms in history, selling off nearly half his position in one of America's largest banks, 6 straight quarters of selling. Then he handed the company to his successor and walked away, leaving behind over $300 billion in cash. $300 billion in cash. That is not what retirement looks like. That is what it looks like when the person who has spent 50 years reading the fine print finishes reading it and decides he doesn't like what it says. The people who run the system know how it works, and they are not keeping all their savings in a checking account. Which brings me to what you should actually do. Most advice on this topic is about managing the damage inside the system. Check your FDIC coverage. Split your money across different banks. Make sure nothing's over $250,000 at a single bank. That advice is fine. You should do it. It takes 10 minutes. But that's rearranging furniture in a house with a structural problem. The real move is reducing how much of your financial life sits inside a system you didn't design, don't control, and aren't first in line to recover from when something goes wrong. Here are 3 moves that people who actually understand this are already making. Move 1. Stop treating cash in a bank account as the safest place for your money. Short-term government loans, called Treasury bills or T-bills, are backed directly by the United States government, not by an insurance fund with $1.42 on the dollar, the actual government. You can buy them directly at treasurydirect.gov with as little as $100. No bank needed to hold them. No middleman. The government owes you the money directly. That is a completely different kind of promise than what a checking account gives you. T-bill rates have been running around 4%. Your savings account probably isn't earning that, and the safety underneath them is in a completely different category. Warren Buffett's company holds more of these short-term government loans than the Federal Reserve itself does. He is not doing that because he doesn't know about savings accounts. Move 2. Understand the difference between what you own and what you're owed. Of all the money you consider yours right now, savings, retirement accounts, investment accounts, how much of it is actually in your name, held directly by you, versus sitting inside a bank or investment firm that's holding it on your behalf? When you own something outright, real property, a business stake you hold directly, something physical you control, that thing sits outside the line we talked about earlier. Nobody else's bets are ahead of it. You are not a lender waiting to be paid back. You are the owner. That is a different legal position entirely. Start being deliberate about the difference between having money and having a promise that someone will give you money. Move 3. The one nobody talks about. Don't keep all your money inside one country's banking system. The people who built the U.S. banking system do not live inside it the way you do. They hold assets in multiple countries. They have bank accounts and investments in places that aren't controlled by the same rules the U.S. government sets. Not because they're doing anything illegal, because they're doing exactly what the system itself taught them. Don't put everything in one place. For regular people, this used to feel complicated or extreme. It isn't anymore. A second bank account in another well-regulated country, property or real assets outside the U.S., holding some of your savings somewhere that isn't tied to the same decisions the Federal Reserve makes. These are moves that informed people in their 30s and 40s are quietly making right now. All of it legal, all of it straightforward, and all of it outside the blast radius if something goes wrong with the U.S. banking system. I know for some of you this feels like a big step, so let me reframe it. Your bank didn't ask your permission before eliminating the rule that kept some of your cash on hand. The regulators didn't ask your permission before voting to shrink the safety buffer. The lawyers who wrote the bail-in law didn't ask your permission before deciding that the bank's financial bets get paid before your savings when the money gets divided up. These things happened. They apply to you whether you know about them or not. The only question is whether you respond to what's actually true or wait to find out how it plays out from inside a system you didn't choose. First, go to FDIC.gov and use their free calculator called EDI. Enter every account at every bank. Find out exactly how much is actually covered and how much is sitting above the insured limit. If anything's over $250,000 at a single bank, move it today. 10 minutes, free. Second, open a TreasuryDirect.gov account. Takes about 15 minutes. Put even a portion of your savings there. Not because it's exciting, because you are moving that money out of the line entirely and into a position where the U.S. government owes you directly. No bank in the middle, no insurance fund running on $1.42. Third, start asking yourself where your money actually lives, not just which accounts are insured, where the money is, who controls it, which country's rules it's tied to. You don't have to solve this in a week. You need to start asking the question this week. The system has survived a long time. It might keep surviving, but the people who designed it aren't betting their own futures that it will. You work hard, you save, you do everything right. The least you can do is make sure you're standing on the right side of the fine print. If this is the kind of straight talk you've been looking for, no jargon, no soft pedaling, just what's actually happening, subscribe. This is what we do here. And tell me this, of all the money you consider yours right now, savings, retirement, investments, how much of it is actually in your direct control? Not insured, not promised, actually yours in your name that no bank or government can touch. Drop your answer in the comments. I read every single one.